Finance, and in this particular video we're going to talk about creating the Excel sheet with the data and revenues and costs for the project that we are going to look at, right, as evaluating. So if we go back to our discussion around what was the project, we were saying that Future Group is planning to add these 3 new stores, and the 3 stores would be, one would be a concept hypermarket, which is a big store on the retail front. There is a premium electronics store, and there is an apparel showroom that are there, right? So, and the operational activity would be that the hypermarket would be immediately operational, that is in year 1. And if we look at some of the other ones, then essentially we are saying that the electronic showroom would be operational after 3 years, and the apparel showroom will also be operational after 3 years. Apparel is the clothing showroom that they have, and electronics is the variety of showrooms that are like Chroma or eZone that they already own, right? They're now moving to a premium one in that category. Let's say hypothetically this is what we have at this point of time, right? We're also saying that they have already spent 500 crore as marketing research expenses to get the necessary licenses. This amount will not be recovered if the stores are not built or not functional. The depreciation would be in a straight line over 10 years, which means 500 crore has been spent. Every year there will be a 50 crore depreciation. In addition, there is going to be a cost of constructing the stores, which is 200 crore and 100 crore next year. 100 crore now and 50 crore for the next 2 years, 100 crore next year and 50 crore in the year after that, right? So that's the broad premise of how the total construction cost would come in, and how we are going to kind of put that in and look at the data. This is what is effectively going to be my capital expenditure, or in other words, the investment in assets. Depreciation would be written down value for all these investments. What do we mean by written down value? You look at last year value and then you multiply that by 10%. So for example, if a car is worth 10 lakhs, then the first year depreciation is 1. That gives me 9. You look at the last year value is 9, and 10% of this will be 0.9. So then the value left is 8.1. Then you look at the last year value, which is 8.1, and 10% of this would be 0.81. So you're left with 7.29, and so on and so forth. So in this case, the value never goes to 0, which is what would happen in real life, right? In a straight line method, at the end of 5 years, the car's value, or 10 years, the car's value would be 0. In real life, there would still be some sort of money that you can make out of that car if that comes in. So that's what is going to happen with the written down value. Now let's also look at broadly what they talk about revenues. We'll actually come back to this in a moment once we have put in the capex data into the Excel file that we're going to work on, right? So what you see on the screen is broadly what capex they have outlined, which is the hypermarket would have 200 in the first year and 100 in the next year. Electronic showroom would have 100 followed by 50 and 50. Apparel showroom only comes up here 100 and then 50 here, right? We're going to assume some stuff here. The first book value of the initial investment is given to us, which is 500, and that's going to get written off over 10 years, 50 each year. So at the end of the 10th year, basically we're left with 0 at the initial investment that is done, right? That's a straight line depreciation that we have assumed, and that is basically in line with our broader assumptions. Now we need to find out the total book value of all this new investment, right? Total book value, and let's actually write down here new investment that the company is doing, right? So that's nothing but the sum of all these things put together, right? And that's the sum of all these things put together. Right now, the book value will change. So I can't use this formula, is because last year's capex plus this year capex is going to give me the total value, right? So I'm going to use the formula here as last year's book value plus the capex I have done in this year, and that's going to give me 300. And then I can increase that to the next year. So 300 plus another 250 added gives me 550, plus another 100 added gives me 650, and then I can drag it in the future. So my fixed value of the cost of the investment is at 650 after the 3rd year. It doesn't move beyond that, right? Now what is said is depreciation is basically 10% of the remaining value, right? So I can club in 10% of whatever is the remaining value. In the first year